Here are the crypto top headlines covered in this video. Bitcoin's halving won't see a 600% return this year, so adjust your strategy. Next, Representative McHenry hopes digital asset bill passage will be his biggest win. Also, U.S. Treasury official outlines proposals for tighter crypto crime control. Welcome to Crypto Top Headlines, where there's no clickbait thumbnails or titles, and no speeches on my opinions, just bringing crypto's news to you. We have a quick request that doesn't cost you anything in order to help. Help us grow this channel to 1,000 subscribers by September, which would be our channel's 1-year anniversary. All we ask is that you click on the like and subscribe buttons, as well as the notification bell. By clicking on these, it does help grow the channel, so thank you in advance for doing so. Now, on to these headlines. Our first top headline, Bitcoin's halving won't see a 600% return this year, so adjust your strategy. Bitcoin's price volatility for the last 30 days stands around 4%, down from nearly 18% in April 2013. It's starting to look more like a traditional equity. The clock is ticking on Bitcoin's halving, and it appears the ETF mania has accelerated the timeline of its arrival. Indeed, we have just a couple of weeks left before the big event, so it's no surprise that the halving is all crypto investors and media can talk about right now. But while we can still expect some predictable trading behavior in the wake of the big day, we're now in a very different market that calls for different trading strategies. Over the past 3 cycles, the halving has been all about the huge spike in volatility. We would typically expect a sell-off of 30 to 40%, followed by a stratospheric rise to new all-time high within an average of 480 days of the halving date. This time, though, the spot Bitcoin ETF has changed everything. To understand where the price of Bitcoin is going from here, it is the asset's volatility that we need to look at more closely. Over recent months, we have seen the anticipated drawdowns as pre-halving excitement builds, yet these drawdowns have been anemic by previous cycles' standards. This time, Bitcoin's corrections have been far shallower, not exceeding 25%. Indeed, the latest drawdown was only around 15% before BTC bounced back once again toward the $70,000 mark. This more muted sell-off is a harbinger of a softer rally once we're over the halving hump. There's little doubt that Bitcoin will see the customary sell-off following the halving, and it will certainly reach a new all-time high after. Equally, returns will still look a lot more exciting than they do for, say, traditional equity holders, but don't expect the more than 600% price increases we saw after the last halving in 2020. Those days are over. So why is this happening? There are 2 factors at play here. Firstly, the percentage of long-term Bitcoin holders has reached a record of around 14 million BTC, more than 70% of the total circulating supply of 19,670,043 BTC. Over recent months, record amounts of BTC have been withdrawn from exchanges to cold wallets as more and more holders adopt a diamond hands approach. But what really has led to a pronounced shift in behavior is the arrival of the spot Bitcoin ETF. Today, ETFs are hovering up more BTC supply from the market than miners can supply. On average, spot BTC ETFs have taken in roughly 10,000 BTC per day since launch, while miners are only generating 900 new BTC every day. This is exacerbating scarcity and leading to upward price action. Crucially, though, this also means a drastic drop in long-term volatility because ETF investors are far more long-term minded than the average crypto trader. Though we've seen a spike in volatility recently as we approach the halving event, it remains well below levels we've witnessed during previous halvings. CoinGlass data shows that the 30-day historical BTC to USD volatility has dropped from a high of nearly 18% in April 2013 to around 4% at the time of writing. You'd expect to see this percentage on a U.S. equity fund fact sheet, not a cryptocurrency price chart. This is because the investors coming into the spot Bitcoin ETFs now are those same mom-and-pop investors and institutions who have poured trillions into S&P 500 ETFs. They are long-term holders for whom 3 years is the minimum investment term, and their decisions to buy or sell an investment are dictated by long-term drivers like macroeconomic conditions, structural market changes, and long-term return potential. So what does this mean for investors hoping to profit from the halving? They'll have to think a lot more like the traditional equity investor than the crypto degen. They'll have to swap Messari for Morningstar, a global provider of data on traditional funds, to gauge the ebbs and flows of spot Bitcoin ETF assets under management. They'll have to keep one eye firmly fixed on what long-term holders are doing because they are now the ones in the driving seat. And if they want those 600% returns, they'll have to look elsewhere. That's not what we'll see after this Bitcoin halving. The trade-off, though, will be steadier, more reliable returns that won't skew the volatility profile of a typical balanced portfolio out of all proportion. And for most investors, this is a much more appealing prospect than an asset that has a 50-50 chance of going to the moon or disappearing completely. Let me pause here for a moment. If you're getting value out of this video, please click on the like and subscribe buttons as well as the notification bell. Our next top headline, Representative McHenry hopes digital asset bill passage will be his biggest win. The retiring chair of the U.S. House Financial Services Committee is optimistic about digital asset legislation now before Congress. Representative Patrick McHenry, chair of the United States House Financial Services Committee, who has announced that he will not seek re-election in 2025, said he saw hope for the passage of legislation on digital assets before the end of his career in politics. Speaking at the Bitcoin Policy Summit in Washington, D.C., McHenry summed up his hopes for his remaining time in office. We don't have a federal law, a definition of a digital asset. We don't have in federal law a means of exchange for a digital asset. We have to provide that clarity. McHenry said, the key thing to remind members of Congress, though, is that we now have this thing that is not defined in federal law. McHenry expressed his hopes for the Financial Innovation and Technology for the 21st Century Act and the Clarity for Payment Stablecoins Act, both of which were approved by the House Financial Services Committee in 2023. The former bill would state clearly what is a commodity, what is a security for digital assets, and it would create a means of exchange, McHenry said. McHenry was optimistic about the stablecoin bill. He has been working for 2 years with his counterpart on the House Financial Services Committee, apparently ranking member Maxine Waters, and they have achieved an understanding. Its passage into law would be the first sign that there is hope and there is bipartisanship when it comes to this digital world. McHenry took crypto opponents to task for their lack of knowledge. If they just take the time to read Satoshi white paper, it is a much easier conversation. That willfulness to not educate themselves leads them down rabbit holes of misinformation. Nonetheless, McHenry said he hopes to see the stablecoin bill passed and we can create some level of clarity by a definition which would then codify a property right. In addition, he said he considered digital privacy another priority. In all, if we can get clarity around digital assets, that is going to be the biggest win of my 20 years in Congress. That would be fantastic. Other aspects of cryptocurrency regulation were in better shape, though. I believe the Biden administration is good enough to go on energy question, McHenry said. Our next top headline, U.S. Treasury official outlines proposals for tighter crypto crime control. U.S. Deputy Treasury Secretary Adewale Ademo told the Senate Banking Committee that terrorists prefer cash, but the department is worried about crypto's growth. United States Deputy Treasury Secretary Adewale Ademo continued advocating for more enforcement powers for his agency in testimony before the Senate Banking Committee on April 9th. In a hearing on countering illicit finance, terrorism, and sanctions evasion, Ademo outlined 3 proposed reforms to improve U.S. enforcement efforts against international bad actors using crypto. Ademo was following up on proposals made by the Treasury Department in November. In his latest testimony, Ademo listed 3 changes the department was looking for. Those were to introduce secondary sanctions targeting foreign digital asset providers, engage illicit finance. U.S. sanctions prohibit institutions from using U.S. correspondent accounts and transaction processing through banks, Ademo said, but crypto exchanges and money services do not always depend on the use of correspondent accounts. A new secondary sanctions tool is needed. We can clarify that our authorities can reach extraterritorially when digital asset entities harm our national security while taking advantage of our financial system. Ademo did not elaborate on the form the new secondary sanctions might take. The second reform the Treasury is seeking would expand the powers of existing authorities to reach the digital asset ecosystem. Third, Ademo said, addresses jurisdictional risk from offshore cryptocurrency platforms. He called the last point a key challenge. He noted, there is clear overlap between these proposals and the bills coming out of this committee. Ademo was referring, at least in part, to committee member Elizabeth Warren and Chair Sherrod Brown's Digital Asset Anti-Money Laundering Act of 2022, which Warren reintroduced in the current Congress. Both authors are prominent crypto skeptics. Ademo pointed to the use of crypto by terrorists, North Korea, and in the fentanyl trade as evidence of the Treasury's need for greater enforcement powers. He conceded that we continue to assess that terrorists prefer to use traditional financial products and services, but cautioned, we fear that without congressional action to provide us with the necessary tools, the use of virtual assets by these actors will only grow. Banking Committee Chair Sherrod Brown released a statement supporting the Treasury Department's enforcement goals ahead of Ademo's testimony. Ranking Member Tim Scott praised the work the Treasury Department has done, but concentrated on foreign policy issues that he believes threaten U.S. security. So this concludes Crypto Top Headlines. If you haven't already done so, don't forget to click on the like and subscribe buttons as well as the notification bell. Also, leave your thoughts in the comments and share this video with your friends and family. Thank you all for watching Crypto Top Headlines, bringing crypto's news to you.